Welcome to Scope's Portfolio Manager Conference. My name is Manqing Sun, mutual fund analyst from Scope Analysis. For today's session, I'm very pleased to be joined by our guest speaker, Edward Lees, co-head and senior portfolio manager of Environmental Strategies Group at BNP Paribas. He's joining us on the line this morning from London. Good morning, Edward.
Good morning.
So today we will tap into a planet-saving, decade-long investment opportunity driven by the urgent need to restore our oceans, lands, and communities. Half of the world's GDP is dependent on nature, and every dollar invested in restoration creates up to $30 in economic benefits. So please join us today for a discussion on how to go beyond carbon and invest in the UN decade of ecosystem restoration. Here's how the hour is going to work in today's session. Edward will address some of the questions that our investors are most interested in and walk us through the strategy, the logic behind screening. Meanwhile, we're open to Q&A from audience. That is why I would also like to encourage you to write down your comments or questions. The whole session will last about 30 to 45 minutes, and you could view the full clip of replay on our platform, Scope Explorer. So without further ado, let's just get right into starting with a question on Edward. First, tell us about yourself. How long have you been working with BNP, and what is your background relevant to the particular asset class?
Sure. Well, I actually haven't been at BNP Asset Management that long. Just under 2 years now when Ulrich and I joined together. My longer background is I started in finance in 1994 doing investment banking for Morgan Stanley in New York, some private equity for them. I started at Goldman Sachs in 2000. That's where I met Ulrich. We've really been working together ever since, so for the past 20 years or so. And we've always done a lot in natural resources, broadly speaking, energy, materials, industrials, agriculture, and that has been where the early shoots of some of the green industries were. So we've been involved in a lot of different green industry names for a long time now, but also some brown names alongside that, and that gives us, I think, the context to evaluate a lot of these names, and then together Ulrich and I have been on the hedge fund side of the business. So we come to BNP with a bit of a long short background, which brings a little bit of a slightly different investment approach to what we do here at BNP.
Mm-hmm. So we know, as you mentioned, we know you have a proven track record of impact funds. This strategy builds on the success of two funds, Energy Transition and Earth Funds, both co-managed by you and Eric. How you divide the work for this ecosystem restoration fund? What is your role here?
So Ulrich and I are both co-portfolio managers, and that model is sort of hard to get to work unless you've really ironed it out over a long period of time, which we have over 20 years. And when you do that, there's a lot of strength to it because you can understand your own personality, the personality of the other person.
Yes.
There's a lot of rational decision making in investing, but then there's also a behavioral and an emotional element, and it's by understanding yourself and where you're strong and where you're weaker. You can become a better investor, and with Ulrich and I, that's meant that we've developed a very good routine through up cycles and down cycles over many years of knowing when to let the other person lead, when the other person might be a bit stronger, and so we really support each other. It also means that you just have more eyes on the portfolio, all the time. It's easier to take a little bit of a break once in a while. But we cover all sectors ourselves. We're used to building businesses ourselves and doing everything from A to Z, from the portfolio and risk management, and as well as the individual asset evaluation and the research. Of course, we've grown a bigger team here now with 6 people. But what we tend to do is cover all the sectors that the other person covers so that we can challenge each other on ideas. But we'll have a little bit of a geographical bent. I'll spend a bit more time in the Americas as being American. Ulrich will spend a bit more time in Europe being Danish. We'll both sort of cover Asia. But now we have a native Cantonese Mandarin speaker on the team, so they can really help with Asia. And then we have another fundamental analyst supporting us as well. that can help us broadly across the globe. So I think we're pretty well staffed now compared to when we started, which is great as we add the new fund, and indeed as the other funds scale. We started here with about 110 million euros, 120 million euros, I think, with the energy transition product, and we now have about 4 billion ish across the three strategies.
Mm-hmm. So I think we already got a question from the audience, but it kind of like would fit into a question for later on, and then so Edward could maybe answer this question first. This strategy is one of the pioneers which invest in this very theme. Most of your fellow strategies are led by government or regulators, which is inspired by UN Decade Initiative. So honestly speaking, from a risk-reward perspective, has adding ESG truly been appreciated as a source of alpha or more of a social mandate? Could you weigh on this? And the question from the audience is, where can investor see the positive impact the fund has?
Okay, let's see. Let me try to separate some of those different questions out. So you asked, has ESG truly been appreciated as a source of alpha or more social mandate? This is historically has been sort of a position that you'd hear, around the world, but also in the US, about how if you narrow your universe, you'll diminish your ability to create returns, and you'll have a suboptimal position on a sort of on a portfolio optimization curve. You sort of restrict your options, so therefore you restrict your ability to maximize return per unit of risk. Mathematically, obviously there's logic behind that, but what it misses is if you're in the midst of a real secular growth theme with a lot of interesting structural growth winds behind you in, say, renewables and green energy and sustainability. We all have finite mind space, right? We don't have an infinite amount of time to evaluate things. So you want to focus your mind hours into areas that are more productive. So by focusing in on an area with very strong structural growth themes, you basically are creating a target-rich environment or a needle-rich haystack, however you want to think about it, which can help your returns. The other thing I'd say is things are muddled on that front numerically if you look back over a long period of time across E and S and G. But if you look more recently, particularly in E, there's a lot of studies that show that adds alpha. And the common sense explanation for that might be that in part those businesses no longer need subsidies in the way that they used to. They're actually creating a lot of value on their own now. They're economically very competitive. And growing very, very strongly. So there's a strong alpha signal there. I think, as an anecdotal data point, we can sort of demonstrate that through the performance of our funds, which have outperformed strongly and really do have a very pure thematic environmental solution sort of focus. And there's more I can say about ESG as well. Maybe I can come back to that, though, and just lead into the question from the audience about where do you see impact in what we do. So we I think a really key thing with what we do is we try to move beyond ESG, right? So ESG systems at their heart are really measures of to a degree, measures of transparency and disclosure, how many policies you have, how you do things. Smaller companies have fewer policies, larger companies have more. That helps them. And even with that, it's a complicated measure because E is different than S, is different than G. There are lots of different KPIs. The data quality is different. People construct these things in different ways, and therefore different providers will have different views even on the same company. What these scores, you're adding apples to oranges to pineapples and trying to come up with a normalized framework across which you can compare lots of different companies. And that's a very challenging job. It doesn't mean you shouldn't try. It doesn't mean there isn't some good things that come out of it, but you have to be aware there's a lot of false positives and false negatives as well. So whilst we do ESG scoring, we think it's a messy measure in terms of its direct correlation with alpha creation. And what you have to do is move beyond it to really look at what companies are doing. Don't be agnostic about what they're doing. Really pay attention at a very simple level, in a way, to whether or not they're solving a problem. Look at their products and services. Does a majority of, a significant amount of their revenue, CapEx or R&D dollars go towards doing something that makes a difference? You could have a company that is as an example, sort of a video game company that wasn't there yesterday, pops up tomorrow, and very diversified board, racially and across gender, and very low carbon footprint, and everybody likes it, and teenagers love it. Right? The stock goes up, makes a lot of money. So on paper, it looks like a great investment for your green fund, in terms of, or your ESG fund, very good on social and governance, let's say, and very low carbon footprint, all this stuff. It has done nothing to solve the world's problems. It's just tacked on top of what we're struggling with today. So that's not what we do. We try to demonstrate having more impact, and here I say impact with a lowercase I, because capital I impact fund sort of means something else historically. But we try to have impact in the secondary markets by focusing our investments on companies that are doing things that matter, solving problems, solution providers. And that gives us a bunch of thematic purity. We also look across the market cap spectrum. We try to not just be in big cap, but also mid and small. And this also allows us to get into deals, right? So we do, one thing that's different in what we do is we are involved in a lot of primary deals, IPOs and pipe deals too, to a certain degree. And this is great because it's putting money in the ground, where we can really show and talk about stories with very exciting companies, where we are helping them to develop their solutions and hire staff and build out facilities. And that is a demonstrable way of having more impact than just buying shares in the secondary market. So I think that that's a key way. And maybe the last way I would say we try to sort of show the impact of what we're doing is as much as we can in the secondary markets, is by providing a quarterly environmental report to our investors for all of our funds. And that goes through carbon, waste, water intensity measures, footprint measures, pollution, recycling, as much as we can. The data is imperfect, but it gets better each year. And we're improving the report as the data improves. But it's important that we try to have something to show. But we also try to go into revenue segmentation, green revenues, SDG alignment, and even profiling companies, saying, hey, look, here's a company that we're invested in, one of the, a larger, interesting company, look what it's doing. And, and we also will profile a smaller company, one perhaps where we've given money to actually, for them to accelerate their operations, and talk about why we did that. So we hope that really means that you don't just have to take our word for it. Investors really can be armed with some information for their own stakeholders as to how we're doing things in an interesting way.
So looking at the strategy, why ecosystem restoration among all thematic topics? What drew you to that specific topic?
Well, we already had and have a energy transition fund, which is focused on decarbonization. So that's sort of a big box out there that needs to be ticked. But we're aware that we need to broaden, and investors, the general, the world needs to broaden its view of sustainability beyond just decarbonization. I mean, look, after all, everything's connected, right? We all live in connected ecosystems. The carbon in the air affects the rain to make acid rain, which affects the oceans, and the carbon in the air is affected in turn by the number of trees and how we deal with sequestration of carbon in soil and our farming practices. It's all linked, and we can see the worrying headlines in this area, whether it's worrying about bees and pollination, whether it's worrying about general species extinction, and whether it's biodiversity and monocrops, whether it's water quality. I mean, we have evidence of very serious issues in let's call it kind of pools of natural capital around the world and ecosystems around the world that really needs to be addressed. And most of the attention of the world so far has been on decarbonization. So it was an obvious thing, particularly because it's all linked together, so it's very synergistic, to move into this as a follow-on fund to our decarbonization fund.
So how do you define the universe? What are the main screening criteria? What are the traits or characteristics of companies that could make it to your list of portfolio?
Well, we want to have some breadth. Right? You don't want to just be a water fund or something. You want to be able to diversify, not just across geography and market cap, but also across industry and theme. And so the key here really are companies that are providing solutions for our ecosystems. And we look at three broad buckets for ecosystems. Ocean and water systems is one. Land, food, and forestry is another. And then our own communities as ecosystems, sustainable cities and buildings. And that's in line, by the way, with the UN Decade of Ecosystem Restoration, which also has human cities and settlements as ecosystems too. So within these, there's a lot of sub areas that are interesting. Aquatic ecosystems, there's of course aquaculture, flood control and solutions, water pollution control, efficient irrigation systems, a lot of stuff on sort of water treatment and infrastructure, but also alternative shipping, ways that we can decarbonize that. Are interesting. Land, food, and forestry, a lot going on the agricultural space now. I mean, that's one of the most exciting places that we're investing in. Agricultural, and it's not just like things like seed technology. It's sensors, it's greenhouses, it's new ways of logistics, it's alternative protein, new ways of new tech on the animal feed side. But then there's a lot of pollution control as well, and, sustainable forestry and plantations, and sustainable cities and buildings. There's a lot of to do with the circular economy and recycling and waste management, but also how we actually have less pollution and a lower and diminish our footprints within cities and creating green buildings, alternative buses. Things like this. So, and there's a teeny bit of overlap. I'd say 10 to 15% with the Energy Transition Fund. But within all of that, there's actually a fairly broad universe for what we are looking at, and it's growing all the time. Right? I mean, we have new companies coming to market all the time. Hopefully it'll slow down a bit now in the summer. But these are areas, given the government support, that we're seeing growing industries and more companies coming into the public market. So it's definitely a growing universe.
Okay. So how do you size the positions? Do you follow any benchmarks? What is the key emphasis for that?
Well, we're benchmark agnostic. I mean, so we have a reference benchmark because, as a reference rate, but we're not following a benchmark and trying to achieve a tracking error. Right? So that's not a solution-minded business. That's sort of a numerical game where our universe would be forced into a more general representation of a broad benchmark. And typically people will screen on ESG scores or what have you, but you're left with things that aren't necessarily solution providers at all. We try to find the most interesting solution providers and the ones that we think offer the best risk reward for our investors, and we invest in them. So we'll have a higher tracking error, but we're also able to, I think, have a much stronger story about the kind of effect we're having, where our goal really through investing is to help minimize society's collective environmental footprint on the world around us. Right? That's sort of our goal, and I think it's important to have sort of a clear goal like that, because otherwise you can get muddled up. A lot of people, when they come to sustainable investing, ESG, SRI, what are you trying to actually achieve? You're trying to increase returns, lower risk, just offer some reporting transparency. If you're not clear with that stuff up front, then you won't know whether your methods are aligned with achieving that outcome. So you need to know what your outcome is. Our outcome is simple, trying to really make a difference. And therefore, we really look to pick fund positions independent of just what's in the benchmark. Now, sizing, It comes down to a number of things. It comes down to individual stock considerations, and then sort of broader portfolio considerations. At the stock level, we want to think about the relative risk rewards, but also in the context of size, liquidity, volatility, things like this, to understand where we think we should put more money on a relative basis. But then one also has to aggregate those positions together and look at cross correlations and look at different concentrations across a varied range of criteria at a portfolio level to think about how one distributes the capital sensibly. But sizing, typically would probably be 1 to 5% of NAV.
Okay. So we also know that inherently smaller caps are relatively under-researched. And unfortunately for ESG, there still remains a lack of universally accepted reporting standards. How does the team cope with data quality of smaller pure players?
Yeah, so, I think this is one of the challenges that ESG processes have. And it runs into these issues, not just with small companies, but with larger companies too. But they're more pronounced, you're absolutely right, at a small company level. That would be a challenge if we were investing because of ESG scores. What we do is, we're really trying to get comfortable with revenue segmentation, detailed revenue segmentation, and CapEx and R&D analysis, first and foremost. And, if that company is doing something that matters, the what, of what they're doing, then that answers a lot of questions that you're sort of indirectly poking at through ESG framework. So it sort of gets to the heart of it. But what you still have to do, which is where ESG is helpful, is think about whether or not they're then operating in a way that's sort of good enough, do no significant harm, these sorts of tests. And so we'll talk to the company and we'll try to make sure that there's nothing that is too much of a red flag. It is hard sometimes to optimize for all three. E is different than S, it's different than G. They co-manifest a lot of the time, but ultimately they're different. We're trying to optimize for E, subject to not doing things that are really that are disqualifying, I would say, on S and G. But we don't have to tick every single S and G box, because your universe would get quite small quite quickly if you had to sort of have optimal outcomes on all three verticals all the time. And there still is room for these companies to improve and to challenge them. And we'll have a company, we've had a number of these companies where they're doing great things, they're younger, and the chairman is the same as the CEO. And because they need to sort of get it off the ground, and we say, okay, we get it, but you need to split those roles and have better corporate governance. And we push them to do that. So you can sort of affect, or you need to diversify your board. So we can affect that change, once we're a shareholder.
Okay. So there's also another question regarding engagement. Can engagement make a difference when disclosure falls short?
Yeah, for sure. Yeah. So we will and have done a number of times, gone to companies and pushed them to have a sustainability report, to disclose answers to CDP. And sometimes it's a question of resources and time. They don't have the money or the personnel to sort of do all these studies, but they really need to try to answer those questions as much as they can. And so we do that all the time to try to improve the data availability for those small and medium companies. And we definitely let them know how urgent it is, because we know how much of the investment community really relies on these things. I mean, we try to sort of use, we do a lot of bespoke analysis and use a lot of common sense, which is fine. But I'd say the larger chunk of the investment community is not spending the time to do that work because they're not, thematically focused in this area. And they need to see those numbers. So, that's real support for the company that isn't going to come until they get better with transparency. So they hear that, they understand that. And it's just a matter of them sort of putting in the effort. But we definitely do a lot of that. And there's a long way to go on that front too, with not just data availability, but what we'll get to is also data reliability, and wanting to get some of these numbers from a third party, not just taking the company's word for it.
Yeah.
And I think that'll be one of the next stages of evolution that we'll have to go through here, and that'll tighten up as regulators start asking for some of these things, and making the companies know that there's somebody looking over their shoulder, so the numbers sort of have to have to be reliable.
Okay, so let's talk about risk management. Given the nature of the strategy, do you think there is a higher risk of sector clustering? If yes, how do you tackle that?
Well, there, as a thematic fund, we're not just a broad-based global equity fund or European equity fund or something. So by definition, there's more sector clustering, I guess.
Yeah.
And that's also true for our energy transition fund. But even so, we try to broaden it out as much as we can, so we can diversify. We don't want to just be a water fund, for example. Sort of it feels too narrow, and we need to be able to have some diversification where we can shift weight between different industries at different times if one sector runs away on valuation, or the macro picture changes and creates headwinds for a particular area. So we try to, there is a chance of that, but that's also what can lead to alpha, right? Because we're clustering in an area that's growing massively. A lot of capital is coming into it, and it needs to grow quite a bit in order to solve the problems that we're facing. So the growth potential is very big in these sectors. So there is a benefit that comes from it as well, I think, in that target rich environment that I was referencing before. How do we deal with this? Again, as I mentioned, we try to have breadth in what we do. We try to really look for solutions. We try to be broad-minded, I guess I should say, in where we look for solution providers. So we don't restrict ourselves just to these sectors. If something is providing an environmental solution and it's meaningful, we can look across sectors in order to find that. So we do try to bring some breadth in that way.
Okay, so it comes to the next question. What's your view on the overall risk of the portfolio? Any additional measures taken to protect downside or control the volatility?
I think that the overall risk, it's early days. Right? So the fund ecosystem restoration launched a month ago. So it's sort of early days, but I think it's going to have a slightly lower risk profile than the energy transition fund. I think that where you have a lot of the renewable energy names, there's a little bit more volatility. Here, I think it's going to be a little less here. This is, but what I'd say too is that this is not a hedge fund, right? This is a long-only fund that's meant over the medium to longer term, through cycle, create above market returns by investing in companies that are solving structural problems that we're going to be facing for the next 20 plus years, longer, but that's enough anyway. So it's not a hedge fund that's trying to aim for a vol target with minimal drawdowns, right? So there'll be cycles and there'll be ups and downs here, but through cycle, this fund should outperform the market because it's an immature growing area facing a big unmet need. So our goal is to really maximize our return potential for investors, but whilst creating a responsible risk framework by diversifying quite a bit, not having too much in any one name, diversifying across geography, across market cap, across value and growth, thinking about factor diversification. That's another thing that we do that sort of comes from our hedge fund days. There's a number of different criteria across which you can look. You can also make sure you don't have too many things and high PE, no earning stocks that are just trying to that are making promises for what they'll earn in 2 years' time or 3 years' time. You also want to have some companies that are doing good things and paying dividends today and having good free cash flow yields today. But you don't want to just have that either, because when the market structure shifts, that whole area can underperform too, equally as much. So those are the ways that we really try to protect downside and control volatility. There are some things that we do that are a bit different than perhaps other long-only managers. I'd say there's two things I'd point to. One is that we are a little bit more dynamic with our position sizing. So we will have fundamental price targets for all stocks, downside as well as upside, and even blue sky. But we will adjust those for probabilities and volatility, time horizon, a couple things to come up with these sort of optimized ratios, which we rank compared to the position sizes in the book on a day-to-day, week-to-week basis. And as those change, they'll highlight things for us like, wow, we've gotten most of what we're going to get out of that. We own a lot compared to the current adjusted risk-reward ratio. Maybe we should sell some. Or, wow, look how good the ratio is here according to our analysis. We don't own that much. Maybe we should own more. And that helps returns a lot, but it also helps risk a lot. It helps to sort of keep a transparent, disciplined framework on top of what we do to get out of things as they get a little long in the tooth, and help get into things when there's an interesting opportunity. So that's one thing that's a bit different. We have a big quantitative system for that. The third member of our team is a PhD and data scientist who has pulled a lot of our IP from the last 15 years out of various systems that we developed over the years into an integrated Python platform. So we spend a lot of time thinking about data, big data, and data manipulation and quantitative processes, not to replace our fundamental approach, but to augment it, to layer it on top, to give us extra tools. So that's one thing. The second thing is that we'll also use portfolio insurance from time to time. So we haven't done it yet in ecosystem, but in energy transition at various points, we put on put spreads and some with like look back features. And so we'll have, when we think it makes sense, tail risk structures that will overlay on top of the book. And again, that's sort of a throwback to our hedge fund days, but we'll do that when we think the timing's right.
Okay, so we got a question from the audience about the geographical weight in your portfolio. Why is there such a strong weight in Europe, and why do you see so much potential there?
Well, we see a potential across the globe. We always have we have a lot in North America. We have stuff in Asia as well. So just like our energy transition fund, there are three key pillars, really. A little bit of EM, but that's smaller. It'll grow over time. But broad Europe, North America, then broad Europe, and then broad Asia are all areas that have interesting opportunities. Now, Europe has been pretty forward-thinking in terms of sustainability in the environment, and they've really been leading the world for a while in some ways. Yeah. They're a little bit more in. They're earlier to push back on GMO, and they've been earlier to adopt a lot of different climate-saving measures. And it's great to see the U.S. sort of post-Trump getting back on board with these things. But they're really following Europe's lead. But Asia's coming on strong too. We have net zero from China in 2060, Korea, Japan. We're waiting to see if India follows suit. But I think one thing that's really good with Europe is also been their focus, not just on decarbonization, but the broader environment. So, I think it's why. Maybe it's a cultural thing. Maybe there's a little bit more of we all have capitalist societies, but here in the West, but the U.S. more so than some, that's let industry go a little bit more unfettered. You still have a sort of I think a mentality in Europe of a higher taxes, a little bit more of a social network, a bit more of a governmental presence to make sure things are done appropriately. Whereas in the U.S., historically, sort of politicians have been more inclined to let the market figure it out, which can work for some things, but the market, if it's allowed to take advantage of environmental resources to create more profits, will do so. And Europe had a little bit more of a stronger hand on the steering wheel, I think, or on the tiller to prevent that over the years.
So I think that question is about the sectors. Where do you see value across the sectors at the moment? Could you give us some examples? And while answering that, we have also another question from the audience, but I will address later.
Well, one of the things that I mentioned earlier that's really exciting us is the agriculture space. That's an area where we see a lot of potential for vertically grown crops, as well as sort of high-tech greenhouses, the introduction of sensors to measure, all sorts of things, rainfall, soil quality, and use of satellite imagery alongside to help farmers do more with less, increase yields, not use pesticides, no fertilizer, a lot of exciting things, cut out food mile transportation and all the pollution that comes from that. So an alternative protein, new ways of creating animal feed, fish feed without fish, algae-based fish feed. These sorts of things are quite exciting. So that's one whole area that we like a lot. We're also excited about the areas that are in sort of looking at chemistry, sustainable chemistry, and this can go in a couple ways. It can go in the way of using bio-based inputs to create foundational chemical building blocks that can go and create a bunch of stuff, which are not toxic. So instead of using barrels of oil to create these chemicals and having a lot of toxic elements from those processes go back into the land, and we're all exposed to more and more toxins all the time. I'm sure that feeds into some of the various disease profiles that keep growing in the West. These aren't toxic, so it sort of detoxifies some of that chemical supply chain, and that helps land health. But it also feeds into the plastic issue, right? So this is something everyone will be familiar with, but there are increasingly interesting ways to recycle low-quality plastic in ways that don't require industrial composting, but it's actually easier and feasible for them to sort of degrade, or to recycle them, and then true degradable plastics as well, creating them. So both the recycling of old plastics and then true biodegradable plastic on the other side that doesn't need industrial composting, but will really biodegrade on its own. So those are that sort of sustainable packaging area is very exciting because we have plastic flooding everything, don't we? So that's a key thing to be addressed. So those are a couple areas that I think are sort of novel and very exciting.
Mm-hmm. So the question from the audience is that many issues of eco-restoration ask for new solutions, as you already mentioned. It's solution-driven. How do you select the right technologies, avoid technology risk? How do you anticipate, another question I assume, and how do you anticipate public sector investments or state aid to certain projects or certain companies? Is there a political dependency?
Yeah, so it's a very exciting time politically because there's a lot going on, and Biden's plans include a number of things, also for ecosystems and for green buildings, but also broader ecosystems. Some of the first things he did was to roll back some of the liberalizations that Trump brought in. Trump sort of took away a lot of these environmental protection policies and acts, and Biden's in the process of reversing those. He's also rebuilding the EPA, so the Environmental Protection Agency. So there's a lot of politics that are going on, indeed, as they are for energy transition. Will the Greens in Germany win? Will they then therefore accelerate the banning of internal combustion engines like the UK did? As we go into COP26 in November, will there be a further tightening of decarbonization targets like we saw in Earth Day? What's exciting is the extent to which governments are really coordinating, getting on board, and going in the same direction. This was sort of unheard of years ago, right? People would talk about it, pay lip service, you kind of do something, but kind of not. But you can kind of feel that there's a difference now, right? Over the last couple of years, the public discourse, whether it's led through protests and Extinction Rebellion or Greta Thunberg or just normal people, or not normal, just a broader range of people, I should say, including investors. We saw what just happened with Royal Dutch Shell and the activist investor, but also just in endowments. The pressure that students are putting on university endowments. There's so much change happening around the world because we see the headlines, we see the heat waves, we see the forest fires, we see the hurricanes, and it's sort of dawning on us. And ecosystems is following suit, and the politicians are following. Some with heels being dragged, and it's going to still be a struggle, but they are moving. So one has to sort of gauge the believability. There are industries that will require this support. Green hydrogen is one. There are other areas which increasingly don't need it anymore. Solar, wind. They're getting it though. They're getting extensions, but they're economic in their own right. And there's some things in ecosystems that will go through that curve as well. But not all of them need it, right? There are companies that are doing things that make money. They're novel solutions that make money. They don't need subsidies. So it's not all just an immature technology that needs a lot of support for 10 years. So how do we deal with technology risk? That was, I guess, an early part of the question. We always have technology risk. It's hard in some places. New competing technologies can always come out of the woodwork. There can always be a private company or venture stage company you weren't aware of, or something comes out of a lab and it changes the game. Will solid state batteries change the industry for for traditional lithium ion batteries? It's a question. But there's a lot of things that go into commercial success. You also need scale, you need supply chains, and just being better in the lab isn't enough. So there's a number of things to gauge. We spend a lot of time talking to people in the industry, talking to companies, reading through a lot of material ourselves, trying to get a sense of, as best we can, of whether or not they're doing something novel that's really gaining corporate interest. It's a great thing to look for either partnerships or big deals with clients with large industrial players, because they will have done a lot of due diligence on information that won't be available to us. So that's a key indicator when a big well-known industrial player partners with one of these younger companies. That really goes a long way. So you can get information to make educated decisions. It's never going to be perfect, but I do find it easier than years and years ago at Goldman. I also did some biotech investing, and I find here it's a little bit less of a black box, to be honest, compared to that at least.
Okay. So it seems very positive about the outlook of ESG thematic investment. Well, then in the general notes, will there still be enough tailwinds to support positive ESG investment as an investment concept in general? And also, you said Biden administration will probably make U.S. greener. What headwinds will continue to sustain?
So on ESG flows, they've been picking up again recently. They sort of ebbed in the first half of this year, and the green sector, had a sharp sell-off relative to the market, even relative to other growth indices. The green industry is sort of a growth index. So is NASDAQ. NASDAQ did fine. Green sold off. It'll go through these ups and downs, but the trend is up, and indeed it's been recovering. The sector's been recovering nicely over the last month. And what we're seeing is the ESG flows sort of kicking in again over the last month. And, to be fair, they never really took a lot out in the first half, not a huge amount. So the evidence is from last year, ESG inflows were quite strong, and even the first quarter this year, I think. And they're sort of coming back now. So those, I think, the indications are will continue going forward. And it makes sense. I mean, as millennials grow up, they become older, get more money, and everyone below them in age. These are, to a large degree, value-led investors. They care about the world. They care about what their dollars are doing, and their pounds and their euros. So, and their yen. So they're going to increasingly, I think, help support these sort of thematic mission-led investment products, particularly if they make money. Which they can and they do. So this is not at the expense of potential returns at all. I'd say quite to the contrary. When you invest in areas where you have double-digit compound annual growth projections going out for 10 to 20 years, that's a good hunting ground to beat the market in. So that's the ESG flows. In terms of the Biden administration, the Biden administration is making the U.S. greener as we speak, and it's going to continue to. It's a core strategic pillar for his administration to make America competitive well beyond his administration. This is not something he is going to back down on. This isn't a nice to have. This is a critical part of his strategy. And he's, in fact, doing more than just trying to pass laws. He is using every tool at his disposal. Right? So you can get all the different departments on board, Department of Defense, Department of Energy. So there's multiple levers to be pulled, which is important because there's also obstacles to overcome. And this, I guess your question was on what headwinds will you continue to face? Well, a number of Republican senators in the U.S. To start with, who are being very stubborn, will continue to resist. But I think that the cracks are forming, and even the Republicans know that a lot of the renewable industries and sectors are huge employers, even in red states. Right. So this is about growth. It's about jobs. It's about money, and you can't fight that logic for too long. But they don't. They're more fiscally conservative now. They weren't with Trump, but they've now reverted back to their old colors. So that is going to continue to be a little bit of a headwind. But I think it's something that will be overcome with time.
Mm-hmm. I thought there's a question from the audience asking, does the fund really helps restore ecosystem, or is it rather about using resources efficiently?
So we certainly try to help regenerate ecosystems. It's a tricky. It's not just about using things efficiently, but using things efficiently helps to slow the degradation. Mm-hmm. But there's a bit of both, right? There's a bit of both. You don't have, it's a trickier space to invest in than energy transition, because some of these things you have to approach sideways, right? You do not have a lot of publicly listed biodiversity companies, right? For example. So how do you deal with that? You can deal with it through, I was mentioning this before, one of these high-tech agricultural companies that will grow. We're invested in one that grows tomatoes, but it does it in a massive warehouse, greenhouse, which is bigger than Amazon's largest distribution warehouse. Mm-hmm. And it does it with no additional water use needs, no fertilizer, no pesticides, in a perfectly controlled environment. And this is the key, creating tomatoes at 30 times the yield per square foot that you would in an open field. And what does that mean? Well, it means you ultimately, if you roll the strategy out, you need less land dedicated to growing those tomatoes. And here, the interesting thing is this warehouse is built near major population centers, and it displaces tomatoes that are otherwise driven from Mexico, 1,000+ miles in diesel convoys. So you're allowing land to get repurposed. Now we have some other things that are more directly. We're talking to one company now that is more directly related, which is great when you find it. That's using mRNA technology to. It actually has a product that works to fight parasites in bees that's been killing off a lot of bees. So they have a product that directly helps restore bee populations. And that is directly restoring the environment. So we try to get as close as we can to help restore the environment. But you do have to come at it sideways. But a company that just manufactures items of whatever widgets, and say widgets require water, and this company manufactures widgets with less water than the next person, that's not a solution provider because they're making widgets that needed water in the first place. It just doesn't really, we try to avoid that sort of structure, more in favor of the other two that I mentioned.
Okay, I think
but there can be a mix. There can be a mix, and it's a good question.
Okay, I think you clearly explained the logic of your portfolio, and very insightful notes from Edward Lees, portfolio manager from BNP Paribas. I'm sure there's a lot of topic still unaddressed. Unfortunately, we have to stop here in the interest of time. A very big thank you to you, Edward. Thank you for being here today and for the lovely discussion.
Thank you very much for having me.
So hopefully our audience will leave better informed and potentially excited for the opportunities of the new ecosystem restoration strategy. I hope you enjoyed today's Portfolio Manager Conference and have a wonderful day. See you next time. Thank you. Bye.